Hello and welcome to the Global Dialogue. I'm Shereen. Bhan. German Chancellor is here in India with the hope of deepening bilateral relationship between both sides. Also, a large German delegation here in India. Now, Germany's largest lender, Deutsche Bank, has a 45-year-old history here in India, and it's hoping to not just increase its balance sheet, but also its presence here. To help us understand what the outlook is on India, what's happening in Germany, and more importantly, Deutsche Bank's global plans and India aspirations, I've got with me two gentlemen here who know it all. Alexander Muehlen, the Member Management Board and CEO Asia Pacific, Europe, Middle East and Africa and Germany, and Kaushik Shaparia, the CEO of Deutsche Bank Group, India and Emerging Asia. Gentlemen, thanks very much for joining us here on CNBC TV18 on the Global Dialogue. Mr. Muehlen, let me start by asking you, since you're here in India, let's start with the India view. This is, of course, one of the fastest growing large economies in the world today. How do you view India and your own plans here?
So India is a very important market, but it is for two dimensions. It is not just with respect to the obvious one, which is India being a growth region and in the very foreseeable future, inside this decade, becoming the third largest economy in the world. It's the growth momentum overall that will justify a lot more of financial products and needs in the country. There's the obvious one of, the growth needs to be funded, capitalized. It will support more inbound capital, which is obviously a domain that we want to support as a bank. There is rising activities, but then towards 2030, as we anticipate India's economy to reach a $7 trillion level, that equates roughly $4,500 per capita. That will be another inflection point in the story of India, we believe, as the consumption, the purchasing power in the country will just reach a level where it's becoming more relevant also from a consumer point of view for products from all over the world.
So what does that mean then, Kaushik, as far as Deutsche Bank's aspirations for India are concerned? Forget 2030, but closer over the next 5 years or so. What's the aspiration in terms of balance sheet size for you?
I think we are really looking to see ourselves not only as a balance sheet provider, but also as advisory thing. So our balance sheet obviously will grow because I think the clients do expect that to happen. And we will not only support our clients onshore through the deposits which we'll get from our customers, but also with now GIFT City opening up, gives us much more avenue to deploy our balance sheet also using our global resources to the benefit of our customers. So we are one of the few ones which even now have a very quick run-up into the GIFT City whole milieu which we have, and we are amongst the top lenders right now. And we do see ourselves using that avenue also to grow. So the ones which you will probably normally track will be only our local balance sheet, which is published by all banks, which will continue to grow.
Right.
But we will support our clients all around, also through other means too.
Well, speaking of financial innovation that you hope to bring into the Indian market to support the kind of growth that Kaushik just spoke about, give me a sense of what we should realistically expect across your business.
So you can see, first of all, that we're operating in India as the only location outside Europe where we're operating throughout all our core banking pillars. So next to the commercial and corporate banking, the investment banking universe, but also private banking and wealth management, which we operate here. So we feel well equipped and positioned for the country to operate and succeed in the various aspects of banking that will become relevant. But the second leg of relevance is next to the outsized opportunity that we see for the economy itself, it's also the outsized opportunity in terms of talent that is readily available in this country that we're already making very active and a very active part of our platform with respect to tech, with a lot of innovation actually coming from the various centers that we have here in India already, providing group services and technological advancement for the entire Deutsche Bank Group.
Well, speaking of this outsized opportunity, and you spoke about the GCC, and of course you're one of the banks that does operate a GCC here in India. What are the plans now as far as the GCC in specific are concerned? And of the three businesses, investment banking, I mean, it's been a stellar last few years as far as the Indian capital markets are concerned. How outsized is the risk appetite now to make good on that opportunity for you?
It's really, I think everything is going quite good on that. From a GCC perspective, it won't be only restricted to our opportunities only in India, but on a broader basis. And really, we have used our GCC quite well Many have used this as a cost arbitrage, which is probably the way we started 20 plus years back. But now, like Alex just mentioned, we really see this location as a place for talent and abundant talent. So, for example, in terms of you talked about risk appetite, we determine our risk appetite of most of our counterparties around the world from India. We do make term sheets for investment banking pitches or for financing coming out from India.
Okay.
We do risk management of our market risk controls also out of India. So a lot of high-tech kind of jobs, people, not only undergraduates, but a lot of postgraduates and even doctorates do work for us in India, and this is where we see a big shift taking place.
And do you expect to hire more here?
We will continue to look at every location where we can do well, and yes, we have built quite nicely so far, and we look forward to seeing what opportunities can we have. And the way, Shereen, we really look at it, and for example, when I go and meet my colleagues over there, we talk more about how much of productivity do you bring in rather than how many people do you bring in.
Right.
So for us, what is more important is not the number of people we have, but we rather have new processes.
Sure.
Many who they lift and shift processes and just do a cost arbitrage. We shift and we automate things. So we will probably see some of our headcount coming off because from low-tech work we do to high-tech work, and then we do even more. So I think the way to look at this is not in terms of headcount, but what kind of quality support you give, and that's what we will see more and more.
And on investment banking?
Also in investment banking, yes. So we have actually a whole bunch of people who we hire every year from management campuses who work for us for our investment banking side too. And we are one of the foremost hirers in the large campuses, all the well-known ones. So we are there every year.
Well, let's shift focus away from India for just a little bit and talk about the region. And you've had a long history in China and a significant presence there as well, dating back to, 150 years now. What's the sense that you get as far as what's happening in China, about the recovery, about a possible revival? What do you see?
Maybe contrasting the general perception, I personally tend to be more optimistic on China. Yes, undoubtedly the economy is going through a difficult phase. It's still walking off the effects of a real estate bubble. It's not the only country, it's not the first country, and it will not be the last country that has seen a significant deflation of a real estate bubble having taken place. China will continue to reinvent itself. Its importance in the global economy is undoubted. It is the second largest economy in the world and will continue to be the second largest economy in the world for quite some time. That is not to say that geopolitics are here to stay as a macro theme that we all need to be wary of, that we need to incorporate in our corporate thinking, our decision-making processes. But China, also because of its economic interlinkages, increasingly within this region, by the way, but also as you look into the dependency with Europe both ways, is not going to go away. And that ultimately is leading to incremental complexity because of complexity. But no party has a desire, I think, to step away from the interconnectedness from an economic standpoint that exists.
You know, you talked about complexities as well as the interconnectedness. How do you see China reinventing itself? How do you see it pulling itself out of the current situation? I mean, what could be the levers that you believe China is likely to exercise to be able to pull through this?
I think looking at technology as a broad theme, the application of, and I take our industry in terms of instant payments as an example, there are only two countries in the world that are really, one is India, the other one is China. You're looking at other components such as the EV sector, which is now demonstrating, competency and increase export throughout the entire world.
But then you have the tariff hikes coming in.
And then you have the tariff hikes, and this is where geopolitics kick in and make things a lot more complicated for all parties, because it will lead to inflationary effects all around the globe, and ultimately, obviously, suppress kind of the economic activity in China at this juncture. But China continues to operate and recycle capacities where possible. It continues to also offshore activities for which China itself has become a too expensive location. for which many other Asian countries, India included,
Yes.
are beneficiaries ultimately. And you look at the dimension of exports and trade ultimately that China facilitates, whilst you're seeing a kind of a breaking with respect to the Western jurisdictions, you're seeing a massive increase of activity across the Asia corridor, Southeast Asia, South Asia, and then also into the Middle East and Africa. And that's something that we're monitoring very closely as a bank as well, because these developing corridors are obviously the future financial sectors that we also need to penetrate as a global bank.
Well, and that leads me to what you're looking at as well, Kaushik, because you're looking largely at this sort of ASEAN region as well. In light of this diversification that we're talking about, with supply chains being rejigged, so to speak, we've seen the Vietnams, the Indonesias of the world also become recipients and beneficiaries of a large degree of the move out of China, or the decoupling that everyone's been speaking of. What's your own assessment of where things stand and where India stacks up in this?
Well, I can give this with an example. Just recently, I was in Europe and visited about 6 countries, and met in the Nordics, in Western Europe, and every country I went in, there was only one theme. I was trying to explain the benefits of this part of the world,
right,
to our global corporates, and I found interest for India slightly higher than for ASEAN in terms of the attention which it took from the C-suite of clients.
Okay.
So if I have to look at it in terms of attention and wanting to know more, I think it's never been higher than ever in my long career. But at the same time, I think the number of opportunities which come up, we need to better monetize them and convert them into fruition. So I think it's more about a conversion of interest is what India needs to work on. We have some challenges in India which are there. There's no doubt everyone knows about it. It's got to do with how quickly can we let companies come in, how easily can they operate, and so on and so forth. Lots has been done by the country. But I think there's still some more room for us to make it easier for investors to do that.
Let's now talk about what's happening in Germany. As far as the economy is concerned, it continues to be a fairly difficult time. We've just had the IMF cut its growth forecast for Germany. What's your own take on when you expect things to start to improve? Are there any incipient indications of that at this point in time?
I think at this point in time, it's fair to assume that over the next 12, 18 months, we're probably seeing a near zero growth environment for Germany. But when you look at Germany a bit more closely, you're seeing a somewhat reduced overall economic environment. At the same time, you're looking at a very strong labor market. And whereas you look at the capital market perspective, the DAX, the equity index, operates at an all-time high. So there are 2 very different stories that are currently being told, and we can have a long discussion on which one is right. But I think one interpretation certainly is that with respect to the large multinational corporates in Germany, including the Mittelstand companies that are operating in so many countries in the world, the future for these companies is not questioned. But what it also does mean is they continue to stream resources, capital, capacity into those parts of the world, and are expected to do well, where growth can be is being anticipated. And we're coming very quickly back to the India story, and one of the reasons why 2,000 German corporates already operate in the here in the country. With the Asia Pacific conference taking place this week, we expect a lot more corporates that currently do not have a footprint in India yet to inspect, investigate, and then potentially deploy resources down the road. So the bottom line is Germany is a very open, a very export-oriented economy, as you know. That will continue to be the case. And consequently, in particular, as the overall European economic environment currently seems very shy, their focus on operating and globalizing more is going to be key.
Well, you know, it's interesting that you talked about this divergence that we're seeing as far as economic growth is concerned in the stock markets, and you're right in pointing out that actually as far as companies are concerned, the growth is really coming in from outside of Germany, and that perhaps is being reflected in stock prices. But let's talk about interest rates, because that could have some sort of a salutary impact as well. We've seen the Fed move, we've seen the ECB cut as well. What's the expectation on further cuts from here on? Do you expect another cut this year?
We are expecting that over the next 12 months, that more cuts in the large economies of the world will take place. The West in particular, the US will continue to take the lead. Europe will logically follow. We do not anticipate that the cutting will take place as fast as maybe some market commentators would have expected. I think the expectations are being paddled back already somewhat. One of the reasons
primarily because of the strength of the U.S. economy.
The U.S. economy is super strong at this juncture, exactly. The other factor is there's always some bubbling under elements of inflation, obviously, within the system that when you're a central bank, you need to take note of, and you need to see the real data coming through before you make a potential next step from an interest rate point of view. But yes, stimulus to the level of interest rates will be a dominant theme this side of Christmas and going into 25.
What's the expectation on a rate cut here in India? Given the fact that at least on inflation, there still is discomfort, especially on food, because that continues to be stubbornly high.
Correct. And I think our governor has given us a strong indication as to where we are headed. I think we do expect some cuts to take place, but not in the course of this year. So we will see some happening in the course of next year. And I think the fact that we are looking at balancing out growth and inflation is a good problem to have. And I think the way we've managed it so far is that really not impacted growth in a really any major way or a discernible way. At the same time, we can really see long-term inflation coming off. We do think that our own internal expectation on inflation are broadly in line with what we see published out. And we feel that the direction in which the way it's going seems to be headed well, and we will see some next year, but not this year.
Private investment and the fact that it hasn't picked up to the expectation that the government had is a challenge here in India. What's the sense that you're getting in terms of the global mood as far as private investment is concerned? We've got elections in the US, you've got elections coming up in Germany as well. How much of that is weighing on private investment at this point in time?
I think when I look anecdotally to some of the conversations we're having with European but also US sponsors that have never entered India so far, but are now trying to engage into a dialogue, I would feel very comfortable in saying that we are going to see more capital being deployed into India.
Okay.
Again, for a variety of reasons, many players, corporates, sponsors may have gone the easier way in the previous years, as other countries like China have offered higher growth rates and are now gearing their views more on India. But I think the direction of travel is going to be very clear. We're going to see probably more than doubling in the next 5 years in terms of FDI coming into the country.
Okay.
And that also supports our own development in terms of incremental resources that Kaushik spoke about. The advisory work, the M&A activity, the cross-border-ness of banking will pick up in terms of activity. And this is why we obviously do want to support also those that are going to be potential inbound providers of capital for India from all over the world.
Let's talk a little bit about Deutsche Bank specifically now. And you just announced your Q3 earnings. You have, of course, seen a bump up as far as profit before tax is concerned versus the previous quarter. And that also has to do with the fact that you've seen at least a partial release of some of your legal provisioning that you had made in the previous quarter. The concern, however, is on the increase as far as your provisioning on credit loss is concerned. Not unexpected, but still disappointing. That's the view from analysts. How do you respond to that?
I think you already summarized it nicely. I think Deutsche Bank is rightly probably seen as a proxy over the overall state of the Western European and the German economy as a whole. And yes, cost of risk for us, but the industry as a whole has gone up because of the aforementioned zero growth environment that we currently need to operate through. Our overall cost of risk is still lower than our peer set. But yes, higher than we have seen it in the previous year. But we've also given guidance with respect to our outlook for the next year and years to come with this. There were a couple of one-off events, clearly, and sudden defaults, let's say, that have obviously impacted the quarterly results. But overall, and again, putting this into perspective, it's not something we feel worried about. Important for us is that if you look at the top line, our revenues grew by 5% on a year-on-year basis, despite all the non-growth talk that we're seeing in the Western economies at the moment. And as a consequence, and also stringent cost management that we continue to do in those areas that we can control, has led to an increase, a decent uplift of profitability to a 2.3 billion pre-tax profit for Q3.
That's right. But, you know, the other aspect that has got a lot of attention is the possibility of consolidation and M&A activity. And I know that, I can't remember who it was, but somebody within the bank said that you have an equanimous approach when it comes to M&A at this point in time. Anything on the anvil, and do you believe that we are likely to see consolidation given where things stand?
We've always been speaking that Europe in particular does need more consolidation. There's no doubt about it. There are a variety of reasons on why cross-border consolidation, even within the EU, are difficult. And this is why we've seen very, very little of that. Domestic consolidation is obviously the more natural step usually. We, for ourselves, have always said that, you know, Deutsche Bank, we do have a lot of critical mass. We are one of the largest banks already globally in this regard. We had our own work to do in the years of 2018, 2019 as we embarked on our own transition. We're now in a new phase of where the bank is growing very healthily, and we don't want to get distorted by, you know, a consolidation effort that is taking place. We never say never. The right asset appears on the horizon. We will certainly take a very close look, as we've done in the past. So far, that moment or this asset has not come. But we continue to be very clear and outspoken also to the political environment that consolidation is a good thing for our industry. And we will need to see more critical mass when looking at banks in Europe vis-a-vis, for instance, the competitors in the US.
What about M&A here in India? I mean, you know, you've got banks like IDBI Bank up for grabs at this point in time. You've also seen deals taking place with Standard Chartered offloading its retail book to Kotak Mahindra Bank, for instance. How do you look at India and possible M&A opportunities?
I think we all have to look at our strengths. Our strength is actually connecting the international investors, whether it's from FDI, FPI, FII, providing trade solutions, providing financing solutions. And our expertise is really much more international. We really will take a long time to really get anywhere close to the private banks which are so large over here. So we do think that we should stick to our competency, and our competency is around the corporate investment bank, which is where we are investing quite nicely.
I'm going to ask each one of you to close with your thoughts on India to sum things up. Kaushik, I'll start with you.
Well, I think our time has really come. And if you really go and see, it is now for us, I hope we don't go what happened in the recent test match between Pakistan and, was it New Zealand or Australia? I can't remember, right? Where they snatched the defeat from the jaws of victory, right? So I think it's for us to take. I'm very confident that we will get it this time quite right, and really look at not ourselves as just the number 3 economy in the world, but really the one which is going to fuel further growth in the world. Moving from 16% of the world growth coming from India, already we are going to move to 18%, and I'm looking forward to a time when quarter of the growth in the world will come from 1/6 of the working population in the world which resides over here.
Well, that is a nice way to sum things up. Mr. Muehlen, I'm going to give you the final say.
I think the country is handling this very well. The last thing you want, as we've seen with many emerging nations in the world, is to enter into a boom and bust kind of sphere. So having a gradual growth, a rate of 7%, which we're anticipating for the years to come, is very healthy in order to also change the environment. This is the infrastructure, this is the regulation, the legal environment, right? There will be a degree of synchronization with other countries, other jurisdictions, other experiences that have been made in other countries as they evolve their economies. And I think in this regard, India operates in the sweet spot, is not going too wild, in terms of growth, but is seeing a very steady projection into a very different phase that will bring a very significant part of its population into a very different, living environment, including the ability to be a more relevant consumer spending nation.
Right.
And all of these factors right now, India is being viewed as being on the right track.
Well, not just high growth, but consistent high growth. That is the need of the hour. Gentlemen, appreciate you joining us here on the Global Dialogue. We wish you the very best of luck with your plans here in India and with the conference that you're here for, and appreciate you joining us here on CNBC TV18.